Hey everyone, welcome to The Explainer. I am so thrilled to have you here today because we're going to unpack something that sounds incredibly complex, but is actually a brilliantly logical strategy once you see how it works. We're going to break down the exact mechanics of selling put options. And honestly, more importantly, we are going to completely debunk a massive, pervasive myth surrounding it. So get comfortable and let's get started. What if you could build a margin of error into your options trading? Seriously, think about that for a second. If you've ever dabbled in the stock market, you know that trying to perfectly time a stock's direction can feel like a super stressful guessing game. It's kind of like walking a tightrope without a net. But what if there was a way to create a safety net for yourself? A way where the market doesn't have to move exactly as you predicted for your trade to actually make a profit? Well, there is. Okay, let's dive into this. Here's exactly what we're going to cover today. 1. The option buying trap. 2. Enter put selling. 3. Understanding option premium. 4. Debunking the risk myth. 5. Selling puts versus shorting. And finally, 6. The income collection strategy. Let's get right to it. Section 1. The option buying trap. Before we get into the solution, we really need to understand the core trap a lot of retail investors fall into when they first discover options. Traditional option buying is very strict. It's very binary. If you buy a call option, you generally need the market to go up, right? You need it to move above your call strike to make a profit. On the flip side, if you buy a put option, you need the market to go down. In both scenarios, you're forced to make a directional guess, and you have to be absolutely dead on with your timing to see any success. And that leads us to a pretty harsh reality. The game of buying options has very little margin of error. I mean, think about it. For a call buyer, what happens if the market just goes sideways? Or what if it only goes up just a tiny little bit? Well, because of variables like theta, which is the time decay of the option, that call is probably going to expire worthless. This leaves the buyer with a loss. You don't just have to be right, you have to be right fast enough to beat a ticking clock. Section 2. Enter put selling. Now, here's the paradigm shift. This is where we look at options from the complete other side of the table. Let's break down what put selling actually is. First off, unlike buying a put, selling a put actually takes a neutral or even bullish view on a stock. I know that can be a bit confusing at first because the opening transaction involves literally shorting the put option. But here is the absolutely crucial distinction. Even though we're shorting the option, we aren't hoping the stock goes down. We're actually hoping the option's premium drops all the way down to zero. Oh, and fun side note here, letting the premium fall that low has an added perk. A lot of brokers actually just waive their option contract fee when the premium drops to 10 cents or below. Section 3. Understanding option premium. To really get why this works, we have to talk about what we're actually tracking here. If we want the premium to drop to zero, you need to lock in this definition. Premium is literally just the option's price. Remember, an option is a derivative. When you buy normal stock, you make money when the stock price goes up. But with options trading, you're profiting off the moves in the option's price, the premium. Since we're put sellers, meaning we shorted the put, we want the thing we shorted to lose value. We want that premium to just decay away. And this brilliantly illustrates exactly how this plays out in real life. Let's walk through it. Step 1. Microsoft is trading at $250 a share. You decide to sell 5 contracts of the 230 strike put, and you collect a premium of 0.68 per share. Now watch step 2. Weeks go by, Microsoft's stock price bounces around. It goes up to 260, it drops to 240. But crucially, it stays above your 230 strike price. Because of that padding you built in, the options premium just dwindles down. Finally, step 3. If it stays above 230 through expiration, you capture that full 0.68 premium. 0.68 times 5 contracts times 100 shares, that's a cool $340 profit. You didn't need the stock to shoot to the moon, you just needed it to not crash below 230. Section 4. Debunking the risk myth. Okay, so you might be wondering, if it's that straightforward, why isn't everyone doing it? We need to address the massive elephant in the room. Ask anyone on a trading forum, does selling put options have unlimited risk? You are going to hear people screaming about how incredibly dangerous it is. But the actual, definitive, emphatic answer to this question? No, it absolutely does not. Let me prove it to you with this exact number right here, $23,000. Let's jump back to our Microsoft example, where we sold that 230 strike put. By selling that put, you're essentially committing to buy Microsoft stock at $230 a share. So what's the literal worst-case scenario? The absolute worst thing that can happen is Microsoft goes completely bankrupt and the stock drops to zero. If that happened, you'd be forced to buy 100 shares at $230, which comes out to a $23,000 loss, minus the premium you already pocketed. Is that a big loss? For sure. But is it unlimited? No way. The odds of Microsoft dropping to zero are incredibly low, and more importantly, that maximum risk is a specifically defined mathematical ceiling. Section 5. Selling puts versus shorting. So if the risk is mathematically defined, where does this whole unlimited risk rumor come from? What's really interesting here is how people falsely equate selling put options to shorting stock. Selling puts has a defined risk. The stock can only go to zero. But shorting actual stock, that truly has unlimited risk, because a stock price can theoretically just keep going up forever. Same thing with selling naked calls. If you sell a call without owning the underlying stock and the stock rockets to the moon, your losses rocket right along with it. Put selling just doesn't share that risk profile. To put a pin in this myth once and for all, let's look at this direct quote from our source material. The maximum that a seller can lose on a put sale will always be a defined number. It's literally just math. Plus, it's critical to remember you're never actually locked in. You always have the option to close out your position early to cut a loss before a stock drops too far, or just lock in your profits way before worst-case scenario even happens. Section 6. The income collection strategy. All right, now that we've cleared away the fear and the myths, let's accurately reframe what this tool actually is. Put selling is, at its heart, an income collection strategy. You're basically acting like an insurance company, just collecting premiums. But it requires discipline because there's a trade-off. Your upside is strictly capped at that initial premium you collected. Unlike owning the stock, if Microsoft suddenly shoots up from 250 to 300, you don't get to participate in that massive jump. Your maximum profit is just that premium. However, in exchange for giving up that infinite upside, selling far out of the money puts gives you that beautiful padding. It lets the stock price bounce around, even against you slightly, while you sit back and let time and premium decay do all the heavy lifting. So, I'm going to leave you with this final thought. Are you ready to stop guessing directions and start collecting premium? We've seen today that while selling out of the money puts takes patience and a little diligence, it fundamentally shifts your trading reality. It swaps out the stress of needing perfect directional accuracy for a defined risk, income-generating margin of error. It is a completely fascinating shift in perspective. Thank you so much for joining me for this explainer. I really hope this breakdown has given you a powerful new tool for your investing strategy.